Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at CRS, or Carpenter Technology Corporation. CRS supplies specialty metals to a variety of end markets, including aerospace, defense, industrial machinery, and consumer durables. Here's the barchart.com technical opinion rating for CRS. The bar chart rating is a 56% buy with an average short-term outlook on maintaining the current direction. Long-term indicators fully support continuation of the trend. The market is in highly overbought territory. Be watchful of a trend reversal. Well, we clearly think more about this than CRS than they do. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that CRS is well above the moving average line, so the monthly trend in CRS is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line for over a year, so the daily trend in CRS is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. CRS is below the upper Keltner channel line, so CRS is inside the buy zone. Since the trend is up, we want to buy a call. CRS has 6 option chains to choose from. We're going to use the June 20 chain. Right now, the June 20 options have 54 days to expiration. CRS closed at 199 on Friday. That means any calls on the list from 125 to 195 are in the money. Let's take a look at the profit potential for purchasing the 200 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 200 call is 14.10 to 15.70. We try to enter at the midpoint, so we'll use 14.90 as the buy price. Our call option purchase calculator shows that if the CRS stock price is flat at option expiration flat at 199 even, when the options expire, the 200 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 175 strike call to see if it qualifies for the 1% rule. Here is the call option calculator picture for the 175 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the CRS stock price is up 1%, the 175 call will lose 15.8% of its value. We want that to be break even or better, so the 175 call does not meet our requirements. Let's see if the 145 call will work. The bid-ask spread for the 145 call is 54.40 to 57.50. We try to enter at the midpoint, so we'll use 55.95 as the buy price. Okay, I'm stuck. Why am I getting stuck? The 145 call works. If the CRS stock price is up 1%, the 145 call will make a 0.1% or $4 profit. That's better than break even, so the 145 call is the one we'll buy. The call option purchase calculator also shows that if the CRS stock price increases by 2.5%, the 145 call will make a 5.4% or $302 profit. If the CRS stock price increases by 5%, the 145 call will make a 14.3% or $800 profit. If the CRS stock price increases by 7.5%, the 145 call will make a 23.2% or $1,298 profit. The plus 10% and plus 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the CRS stock price does not make the expected move up and remains flat at expiration, the 145 call would only lose 3.5% or $195 compared to the minus 100% or minus $1,490 loss for the 200 strike call that we looked at earlier. Now we want to review a call option debit spread. For this spread, we want to buy to open the CRS June 20 175 strike call and sell to open the CRS June 20 185 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 175 call for $30.85, sell the 185 call for $23.55. $30.85 minus $23.55 equals $7.30. So the entry price or debit cost for the spread is $730. The call option spread analysis calculator picture shows that the spread will make a 37% or $270 profit if the CRS stock price declines by 5%, remains flat, or increases in price when the options expire. If CRS is down 7.5% at expiration, the trade will make 24.3% or $177. Creating the debit spread will allow us to collect a $2,355 cash credit to our brokerage account for the sale of the 185 strike call. As we said in the previous slide, this reduces the cost of entering the spread to $730. Here's a note regarding earnings reports. The next CRS earnings report is scheduled for July 24. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the CRS June 20 145 strike call for $55.95. We also reviewed the spread. Spread said to buy to open the CRS June 20 175 strike call and sell to open the CRS June 20 185 strike call at a debit of $730. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.